Sensex touching 50,000 and Nifty reaching 15,000. So we were very clear that this is a brilliant opportunity to invest and put money to work, and we were bang on our market view at that point in time. 30th March 2020, Nifty has gone up by 77.51%, which is a record return in a particular year. So our view at this point of time is very simple. Markets will gain significantly in the next 5 years from the current levels, and also as the earnings growth is picking up and also the flows to India can accelerate, mid and small cap segments can do exceedingly well along with other market cap segments. I believe that 2020 onwards you would see a significant up move in the earnings cycle, and that would track the markets as well. So we are much more bullish on the broader economy. So we will be tilting our portfolio towards mid and small cap as the time passes by. For last 6 months we have been doing that, and yeah, I think that is what we will be doing in the near future as well. In 2017 to 2020, there was significant underperformance in mid and small cap indices relative to large cap index. So that is when we realized that there is an opportunity definitely brewing in the mid and small cap space. And our outlook on this segment is very, very robust. In the next 3 to 5 years, we believe as the earnings growth picks up in the economy, as well as there is a significant re-rating possibility in mid and small cap space, which is the one which has seen the maximum brunt in the last many years, there is going to be massive return opportunity in this segment.
There can be some bit of correction owing to valuations, because the rally that we've seen, it's only been about expansion of multiples. We've not seen any earnings growth.
Last 27 years is that whenever the earnings have bottomed out, that's not the time to look at price to earnings and get perturbed. Whereas the earnings picks up in the next 3-4 years significantly, which is what I would believe will happen, then you will see the price to earnings compressing and the valuations looking much more cheaper. Generally, markets tracks earnings, and that's what we'll see in the coming years. So corporate earnings have been coming down significantly over the last decade. If you see, because of various interventions by the government, which are more long-term reforms in nature, the earnings were getting impacted in the near term. But we were sure that the long-term tailwinds are going to come from the same reformatic measures which the government has undertaken. March 2020 was the markets coming down, and later on, because of the pandemic, the quarterly earnings also bottomed out. And we are seeing a significant improvement in the corporate earnings. So I believe that this is one of the most interesting time in the market history, that the cyclical sectors will start doing extremely well in the coming years relative to the defensive sectors which have been doing well in the last decade.
So do you think those laggards can be the outperformers of 2020, be it real estate, pharma or the auto pack?
I believe that this is a time to bet on cyclicals rather than betting on the defensive. Zinc companies, when I look at, it is trading at a multi-year low, and decade low. When you're getting these stocks, you have to bet on it, saying that things will improve. If you see the Q2 FY21, the earnings growth acceleration is clearly visible across sectors, which is in line with our view, and we believe that the earnings growth trajectory is accelerating, and which is going to be the main theme while you are looking to invest into equities. So we are very positive on cyclical sectors, which are trading at historically low valuations and can potentially re-rate in the coming years. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.